All right, with that, let's quickly move on to our next guest of the show to talk about what the budget expectations would hold for the markets and what the way ahead looks like. Joining me is Sandip Agarwal, Fund Manager at Sowilo Investment Managers. Sandeep, good afternoon. Today, the markets were definitely jittery. And not just today, I mean, Nifty has already declined by about 4% so far this year. Do you think the budget can turn things around then?
Hey, hi, good afternoon, and thanks for having me on the show. So, see, we are going into the budget with very low expectation, primarily because government, whatever major ammunitions with both RBI and government had, they have already used it. For instance, the deep cut in the income tax slabs, which were possible, that has been done last year. The GST has been reduced substantially. So, government has very low options to do much on the tax side, whether it is direct or indirect. Uh, the only thing which probably which government has in its hand is probably to increase its allocation to the capex side, and I think that is something which everyone will have a keen look. Although government at multiple occasions had also mentioned, including the honorable prime minister and the finance minister, that it is now up to the corporates and the private corporates to take up the capex and do private capex. They have done everything on their part to boost the demand at the consumer level. So the expectations with which we are going is very low, and because of that, I believe that uh, the chances of further disappointment in the budget or any negative reaction is unlikely. At the same time, uh, I think the Indian market will be more earnings driven going forward. So wherever earnings will come, wherever profits will come, growth will come, I think those stocks will quickly, start trading at fair valuation. Some of them are below fair valuation. Some are still, there is some froth. The ones where there is froth will correct meaningfully. And wherever, there has been a deep value now, based on the results which come, I think they will do a catch up rally quickly.
Okay, got it. Sandeep, I mean, a majority of the experts that I spoke to, they're saying that the budget could focus on the capex, particularly for defense. I mean, what's your expectation? Because does it warrant a relook at the defense sector with the kind of valuations it has been trading at as of now?
So the thing is that uh, on the defense side, with the EU pact FTA which has been signed, and if you go by the commentaries of the leaders in the European market, what we understand is that they want to re-emphasize and restart their own defense equipments, defense built up. And I think this FTA, what it will do, it will allow a lot of Indian defense companies to do the outsourcing part of it in a big way. So I think because of that, there is a good chance that defense companies may do well. But remember, they are at a very prohibitive multiples, and that is the reason we have been chasing them for quite some time, and we have not been able to buy because we are a deep value fund. And in our philosophy, the defense stocks don't fit, primarily because one concern we always have, that there is one prime customer, that is government of India, followed by other countries, and that's the reason we have never taken a big bet on the Indian defense side. But let me put it this way: the opportunities are opening up. This is a sector which has done phenomenally well in terms of, you see, the kind of export growth which the sector has seen, and now with this FTA which has signed, even if in next 2 to 3 years there is a chance that structurally the growth will be much better in the sector than in the past.
Okay, okay. Sandeep, since you talked about the India EU FTA, I mean, your multi-cap fund that you are one of the top weights has been the textile sector. Do you think that the deal can offset the tariff pressures?
So, I think this deal is phenomenally good in terms of some sectors, particularly coming the labor intensive ones. And from that perspective, textile looks very good, honestly. And the reason it looks so good is that, these two things. One, the stocks are at a very reasonably priced level. And secondly, the big impact, negative impact, which should have been there, that has already been in the price. So from here, things will improve very substantially. Most of the textile stocks, if you see, they are below book value or they are close to book value, and they are profit making companies. So I don't know any reason why this stock should be at this level. So I think some push from the export side, and if we are able to take some market share from our neighboring countries also, it will mean a very, very big jump from the current levels in terms of fundamental. And I think the re-rating will happen in quite significantly. It may take some time till the numbers show up, but once they start showing up, I think a massive re-rating can happen.
Okay, a massive re-rating is what you're expecting for the textile. But yesterday's economic survey that pointed out there are only a few PLI sectors that have delivered outsized export growth, and several of them have been hit by the US tariffs. Do you think that the budget this time will focus more on the sector-specific PLI approach or just a one-size-that-fits-all the model?
I think this budget will be more of deregulation and ease of doing business, because as I said that from the financial side, lot of things government has already done, and now it will be more about ease of doing business and some deregulation which will make things faster. And that is what we need. We need the speed of the economy to move up substantially, speed of execution to move up substantially from the current level. And I think that is something which the whole industry will also be keenly watching, and I think government will definitely do things on that side. I won't rule out PLI in further few more sectors where there has been some impact of the US tariff also, because see, when we are going to compete at a global level for in next 2 3 years, you have to kickstart those sectors with some incentive and some support, and I think that is what government has been doing, and in my view, that is the best approach to it also.
Okay, okay, got it. But Sandeep, we've seen a large metal meltdown today. Gold, silver prices have retreated. Majority of the metal stocks have been trading, with about 5 to 12% cuts. What's keeping the sentiment in check, and what's the way ahead? Do you think this is just a start of a bearish trend going ahead from here on?
It's very tough to give a call on metal sector, but let me put it this way that the one view which has been there for last few months, that there is a massive shortage and people are doing calculations of how much of silver will be required or different metals will be required in electronics, in power, in semiconductor chips, in data center and all, but they are at the same time not doing the calculation that if the input costs go substantially high or abnormally high, then at some point of time, basic economics which we have learned our schools and colleges suggest that demand is generally elastic in nature. So if the input cost goes up so much, probably the demand of those goods will also come down. And I think that second aspect of the uh, same parameter has not been taken into account, and I think at some point of time rationality will prevail and people will start thinking on those lines. As far as gold is concerned, it is a store value and it is a precious metal, and it also gives you some comfort in volatile geopolitical environment which we are going through right now. So I will not be able to give a call on gold or silver, but let me put it this way that the end industry usage argument which is there, it works both way. If the prices goes up much higher and much faster, then obviously the demand will also see a pause, and that will indirectly balance the demand supply. So I am not of the opinion that one way the metal should go up.
Okay, okay, got it. But Sandeep, do you expect any duty hikes in gold and silver prices in the upcoming budget?
I don't know whether it is required or not, because the it will also encourage a lot of lot of smuggling, or bringing in the goods without paying duties, lot of deceiving of the taxes. So I don't know whether it will be a right approach or right thing what government may think of, uh, but obviously government has much more data and they know how to contain things, so maybe they may consider. But I think the downside of this initiative is that lot of it will encourage a lot of unofficial imports and all those things. So I don't know whether there could be any duty or tax which could be applied there.
Okay, all right. This is something that we'll watch out for. But yes, Sandeep, let's talk about Swiggy. I mean, it came out with its results today, and they have warned about irrational competition in its quick commerce space because of the growth strain that it has observed in Instamart business. Now, the comments have come against the backdrop of an intensifying price war in the quick commerce business. But do you think going ahead, this is something that investors should pay heed to?
So, obviously, there is a huge amount of money which you need to burn to retain your market share and be in the business. And and the burn rates are quite high. So if you see the quarterly numbers, they are burning huge amount of money, and so are other players. So if you see the comments started coming negative from one of the large retail player 15, 20 days back, which said that they are number two in quick commerce now, and they are very aggressively selling. Also, one of the quick commerce players raised money recently, and he has also been very, very aggressive to get market share. So, when this kind of things happen, then obviously, generally, these platforms are always a one or two player market, and the burn rates go up as players increase. So right now we are witnessing a situation where, it is a 3.5 player market. Probably the one burn rates will reduce when it will become a 2 player market. And in this kind of businesses, the operating leverages are very different than the normal businesses. So you have to treat the burn as a capex, because in this industry there is no, you don't have to build a factory or some kind of huge fixed asset. So this customer acquisition cost and customer retention cost, although is charged of according to the accounting standard in PNL, but actually these are the real capex, because this is what you are investing to get clients, and that it should be seen with the lens of capex and not with opex. And this is where all the difference happens. Just to give you data, Amazon started in 97, and 2015 was the year when they made first dollar of EPS, and then 2023 it was almost close to $100. So, it takes 17, 18 years to reach first dollar of EPS, and then it takes only 8 or 10 years to become $100 EPS. So that is the kind of leverage we are talking about. These platforms are generally a 1-2 player market. So I think the first two has a very high chance, both Eternal and Swiggy, to survive and do well. But time will only tell whether some other player will become strong or not. So very tough to give a call, but we love these businesses. We believe that, with the reducing population growth rate and lower fertility rates over next 5 or 10 years, as our per capita income increases, these platforms will play a very, very crucial role in the economy. And people generally tend to, with both husband wife working and all, everyone wants to see the maximum return per hour of work. And from that perspective also, all these platforms will makes a lot of sense, and people want to use them to optimize their own return per hour.
Okay, got it. But Sandeep, any sectors that you're watching out of ahead of the budget presentation? Anything that you're finding attractive at the current levels?
So I think, I don't know what will happen on the budget in this sectors, but I think the manufacturing, the capex, capital goods sector, the manufacturing piece, and the banking BFSI piece will do phenomenally well. We have seen early signs of, some green shoots from the economic perspective, also in the credit growth and in the cement demand. So I think these manufacturing and capital goods and banking are the sectors which can do well. And we also love the recycling space, but in recycling you have very limited listed players, so very tough to play that space.
Okay, all right. And just one last question, Sandeep. I mean, anything that you've been cautious on, because you mentioned that banks and capital goods is something that you're positive on at the time being.
So we are very, very cautious still in the FMCG, which is, a factor of population growth rate and increase in per capita income. More of population growth rate there. We have been structurally negative for 3 years in a row now, and we don't have any reason to change our view. We are also quite cautious in solar theme, complete renewable theme. I think, the capacities which are coming are too much, and it will be very tough to make money in any solar related themes, whether it is the pump space, whether it is the renewable space. So tough to make money there. We are also very cautious in the large cap IT names, because we believe that sector has become broadly X growth. So very tough to assign such kind of peg ratios to a sector where there is no growth. So these are the spaces where we are extremely cautious. We love pharma also, along with BFSI. I forgot to mention that. We love the pharma space. I think a lot of generic players have become very, very attractive. They are trading at a like commodity, and that will not remain like that for long. So, they may give some pain in terms of time correction, but huge money will be made in those names as well.
Okay, all right. All right, with that, we have to let you go, Sandeep, but thank you for joining and connecting with us.
Thank you.
And of course, the markets have